Final speaker, at least before we get into the Q&A portion, to share his insights and wisdom on markets, being a long-time practitioner in the market. It's my distinct pleasure to welcome on stage our chairman, Mr. Edward Lee.
Okay, what I do is, as usual, I will just give a summary of what's happening to the world. And it's always, where are we today? Okay, China last quarter was on the right side already. It has been neglected for the last 4 or 5 years. And then suddenly it created a mini bull market that lasted for about 1.5 years. It was induced by the government. And then, of course, it was just a short-lived confidence. And now we put it back on the right side. And then, of course, Europe is still in a recession. The whole Europe, still 25-30%. And, of course, we're very bullish in Japan, the beginning, the reversal of Japan. And, of course, the US, then the Philippines. Okay, so put it in that order. It's very simple. Look at it from the left side and the right side. Okay, so we'll start with the right side. This is what happened to China. The short-lived confidence that came in, that it's induced. For the last 5-6 years, it was in a no-interest bear market. And then suddenly, China put in a lot of policy to inject liquidity and come up with policies that would create a mini bull market. But of course, anything that involves government trying to induce it, it's always very short-lived. Okay, so let's look at this. China has been slowing down since 2008, 2009. So if you look at the numbers, the GDP growth is from 14% down to about 6.8 right now. We think it's really about 3 or 4% GDP growth, because China, from time to time, will change their numbers, trying to get a perception that the economy is still doing well, but we're seeing those slow numbers. And then, of course, like anything, the US stopped printing money. Europe continues to print. Japan has been printing for the last 25 years. Then, of course, now China is also printing. Now, China is right now about 200% debt over GDP. Like the Philippines, about 40% debt. You know, the only problem with the Philippines is that, we're so strong in balance sheet, but, nothing really is happening. If you look at China, China continues to build build cities, infrastructures in preparation for the future. So this is what happened when this is manipulated by governments. Short-lived bull market, then crash. But of course, we can't be too negative, because the government can continue to print money and continue to save the market. So we believe that the move today is very similar to the US in 1987. This is the Black Monday crash. I was there already. We were watching that market very closely. And look at it. It took about 1.5 to 2 years before it starts going up. So we believe that slowing growth and debt problems would limit price appreciation, but we expect prices to recover on the back of Beijing market supportive policies. So if you're involved in buying China, yes, it might rally, but it will take a while. But of course, like the old saying, we do not fight the Fed, especially the Chinese government, because they control it. They will do as much as it can to try to revive the capital market, but it will take a time. It will take time. All right, so I think in summary, this is China for you. And then, of course, this is Spain. So very similar. It's been going nowhere since 2007, 2008. As long as you have 25-30% unemployment, then really nothing is much going on. So that's the same as what happened to Greece. But look at the credit default swap. I think April showed this a while ago. So look at it. The risk of a contagion is not there anymore. So very simple. Just by looking at the credit default swap, you can see that what's happening to Europe is already discounted by the market. So during the 2011, 2012, then you probably see where in all those credit default swaps, interest rates have gone to the moon. But today, we don't see that anymore. So Europe is neutral. Then, of course, we have Japan. We've been very bullish with Japan for the last 2 years. The only problem is that whenever we speak to all the analysts, everybody would tell me that Japan, with the aging population, nothing was going to work. No? But what they don't know is that Abe did the very simple thing by depreciating the yen. By allowing the yen to go to about 120 today, it created an avalanche of tourists. So just look at this simple number, 2006, 7, 8 million. Today, it could be 18 million for this year. I don't know how many have gone to Japan. You go there, it's cheaper than the Philippines, beautiful country, cheap, everything is cheap, quality food, fantastic. No? So most of the headlines ignore Japan, but the closer look reveals that this is why the reason Nikkei is going to new highs. Great balance sheets, 40% of because of the depreciation of the yen, 40% is cash. So now they're trying to give it back to the shareholders. No? So for those people who neglect Japan, we are very bullish in Japan. Right now, of course, prices are a little bit expensive, but overall, it's really a bull market in Japan. Then, of course, Juanes was saying about, we're always, it's a sideways. What's happening there looks very expensive. And this is always a challenge. No? We don't know if it's going to do the same thing as what they did in 2007, 2008. But like I was telling Dino a while ago, is that the big difference is that in 2007, 2008, interest was at all-time high. Today, interest rates are at all-time low. So I don't know, maybe there will be a flash crash, which would be good, because if the flash crash comes, then we're there to buy the market. But of course, with the Fed talking up the interest rates, they're going to increase the interest rates, which is, I think, the right thing to do, because the big bubble is in the bond market. Because interest rates have been going down since 2007, 2008, at an all-time low. So what's happening is that the Fed is already guiding everybody, because it doesn't want that bubble to explode overnight. So he's been warning people, we're going to increase interest rates, we're going to increase interest rates. And that's why the 10-year Treasury went up about 2-3 months ago. Today we're seeing now 10-year Treasury going back down. No? So because of what happened to China, if China continued to grow at that time, probably the 10-year interest rates would start going up. No? But today we're seeing the difference. And when you're seeing that the Fed is already guiding people that they're going to increase rates in September or even December, they're doing the right thing, because you don't want to create that sudden bubble that it will explode the bond market, because if it explodes, that will also affect the stock market. No? So we believe, and history shows, that a gradual raising of rates is stock market friendly. Now this is from Schwab. Now look at this carefully. And you will see there are 3 kinds: tightening cycles, slow tightening cycles, fast tightening cycles. So this is 6 months before the start of the tightening size cycle. Look at it. So we believe that the US is in that red, violet, red, is that red? My God, colorblind. And because the Fed is already guiding us that they're going to increase interest rates slowly and normalizing it, so we believe that the market is going to go up. Maybe prior to maybe a sudden sell-off, maybe, if the first rate hike would come in. But after that, the market will continue to do well. So if there's any sell-off in the US, we welcome it. We welcome it. So look at the Philippines, the most beautiful, advanced. Juanes says we're at wave 5. So the nice thing about this is that even though we are at the beginning of wave 5, the interest rate is still high or low? Low. So you cannot see a euphoria when there's no overexpansion, there's no bubble. So I believe that we're maybe in the beginning of wave 5, and it might take another 3 to 5 years before we reach the peak. Okay, so the difference is that April showed it, is that it's really the problem of the government. Can you imagine government have savings? Have you ever heard of that? The world is printing money, negative spending, and the Philippines has a savings. But what about this year? Do you think we'll have savings? How many people believe that they will spend it this year? Why? Why do you think? Because it's an election year. Right? It's so simple. It's a legacy spending. All the budget, in fact, they don't spend and still approve a 15% increase in budget. Is it going to the election? Yes. Right? So it's very simple. They will spend it. So maybe we'll have lousy numbers in the first quarter. April is saying that we're seeing some, spending coming in. I believe that there will be a massive spending going to the third and fourth quarter. So we cannot really be too bearish. Of course, the corporate today, most of the numbers are really bad. You look at the advanced decline and what Juanes was showing you, that there's a big divergence wherein most issues are on a downtrend. But I really believe that the market is almost there. It's almost there. No? What we were afraid of early this year, that the 10-year was going to go up, it did. That's why there was a big sell-off in the Thailand, Indonesia, Philippines sector. But today, I really believe that we're neutral and positive. So for what we're doing now with most of our high network client, we're already advising them to slowly go back to the market. Now the sad part is what to buy, in which April have shown you. No? So, but then we're already telling them that 30-40% of their portfolio should be index related. The problem is this. No? The reason why we say it's an index related play right now is because a lot of the issues are going down. A lot of the strong issues are expensive. Right? So there should be a mix. Right? So what we believe is that that's one of the reasons why we're very happy with Marvin and Dino. They came out with this fund supermarket. Now we have a chance to be able to deploy index-related issues rather than individual issues. Okay, so for most people who are still afraid of the market, I really believe that you should start accumulating. We have 6 funds that are, 6 asset management companies that are there. And you can choose equity, please, equity index funds or enhanced index and start accumulating it. Now, you don't want to have all of your portfolio in that because individual, there are issues for you to be able to participate that will give you better yield. But if you're afraid of the market, just continue to accumulate. We think we're very near the bottom. All right? So, in closing, let me share this with you. This is beautiful by George Goodman. The market is like a beautiful woman, endlessly fascinating, endlessly complex, always changing, always mystifying. Then you have observed her a long time. You begin to see little tricks, little nervous movements of the hands. Oops, nawala. She's being paused. Thank you very much.